The truth about retirement is that the system was never built for you to win. It was built to keep you calm, keep you contributing, and keep you out of the way while other people make decisions with your money. I'm going to say something that's going to make some people mad. Your financial advisor, the nice one, the one with the framed degree on the wall, the one who calls you on your birthday, that person is very often not working for you. They're working for a system that pays them whether you retire comfortably or not. Nobody tells you that your 401 kilobits has fees you've never checked. Nobody tells you that Social Security math doesn't work anymore. Nobody tells you that the whole plan you've been following since you were 22 years old was designed in a different economy for a different generation, and it is quietly falling apart while you keep doing exactly what you were told. Stick with me for the next 30 minutes because I'm going to walk you through exactly what's broken, why it's broken, and what you can actually do about it starting today. Before I get into it, I need you to do something for me. Hit subscribe right now. I'm not saying that because I need the number to go up. I'm saying it because what I'm about to explain to you is worth more than what most people pay a financial advisor for an entire year. And I'm giving it to you for free. If even one thing in this video changes how we think about your money, it could be worth thousands, maybe tens of thousands of dollars over your lifetime. So subscribe, stay with me, and let's get into it. Let's start with the 401 kilobits because that's the first lie most people get sold. I don't have a 401 kilobits. I don't have an IRA either. And it's not because I think saving is bad. It's because I understood early on what these accounts actually are and what they're not. A 401 kilobits is a tax-deferred account. That means you put money in, it grows, and you don't pay taxes until you pull it out later. In life, sounds fine on paper. Here's the part nobody explains to you clearly. You have almost no control over where that money goes. You're handed a menu of mutual funds, usually 5 to 10 options, and that's it. You don't get to buy the businesses you believe in. You don't get to move fast when you see an opportunity. You're stuck picking from a list somebody else built for you, and most of those funds carry a fee. A study from NerdWallet found that 92% of Americans have no idea what their 401 kilobits fees actually are. Let that sink in. 92% of people are paying a fee every single year for decades, and they don't even know the number. If you don't know your expense ratio right now, pause this video after I'm done and go check it, because that fee is quietly eating into your future every single year. Whether the market goes up or down, the person managing that fund gets paid regardless of your results. That's not a partnership. That's a toll booth, and you're the only one paying the toll. On top of that, your money is locked up. You can't touch it until you're 59 and a half without eating a 10% penalty on top of whatever taxes you owe. So if life happens, if you need capital to start a business, to handle an emergency, to take advantage of a real opportunity in your 30s or 40s, that money might as well not exist. Think about that for a second. The years when you're most likely to want to take a swing, start something, buy something, move on. An opportunity are exactly the years your own money is locked away from you. Now, I'm not telling you to never use a 401 kilobits. If your employer offers a match, meaning they'll put in extra money when you contribute, that's close to free money. And for a lot of people, that's worth taking. But understand what you're actually doing. You're trading control for a tax break, and you're trusting that the fees stay reasonable and the market cooperates for the next 30 or 40 years. And that's a lot of trust to put in a system you don't fully understand and were never really taught to question. And here's a number that should bother you. The average 401 kilobits balance for a baby boomer, someone at or near retirement age right now, is somewhere around $200,000. Sit with that. These are people who worked their entire lives, followed the advice, contributed every paycheck, did everything they were told to do. $200,000 sounds like a lot of money until you realize that tree's supposed to last them the rest of their life. That's roughly $20,000 a year if it lasts 10 years. And most people live longer than 10 years past retirement. That's not a retirement. That's a countdown. And these are the people who did it right by the old rule book. If the system worked the way it was supposed to, You wouldn't see this outcome for people who played by every single rule for 40 straight years. Now let's talk about Social Security, because this is where things get uncomfortable. Most people think of Social Security like a savings account. They think, I've been paying into this my whole life, so there's a pile of my money sitting somewhere waiting for me. That is not how it works. And I want to be very clear about this. The money you pay into Social Security today is not sitting in an account with your name on it. It is immediately going out the door to pay the people who are retired right now. You're paying 6.2% of your income into this system. Your employer matches another 6.2%, and all of that money is used to cover current retirees. It's not investing on your behalf. It's not growing in some fund waiting for you. It is a direct transfer from working people to retired people, happening in real time. Every single paycheck. Every financial advisor for the last 50 years has described retirement as a three-legged stool. Leg one is your personal savings and investments. Leg two is your employer pension, or 400 kilobits. Leg three is Social Security. The whole idea was that if any one leg wobbled, the other two would hold you up. The problem is, pensions mostly disappeared decades ago. Companies used to guarantee you 60% of your final salary for the rest of your life, but that bankrupted plan after plan because people started living longer and the math stopped working. So companies shifted the risk onto you with 401ks instead. So now you've got a stool with one leg gone entirely, one leg that's shaky because it depends on the market and your own discipline, and one leg, Social Security, that has its own separate set of problems. You're not sitting on a three-legged stool anymore. You're sitting on something a lot less stable, and almost nobody has updated the advice to reflect that. Here's why that matters so much right now. The math on this only works if there are enough young workers to support the retirees above them. But we're having fewer babies. The workforce is shrinking relative to the retired population. And at the same time, you've got the largest generation in American history, 78 million baby boomers moving into retirement all at once. That is a massive amount of money going out with a shrinking amount of money coming in. This is not a conspiracy theory. This is basic arithmetic, and it's why the Social Security Trust Fund is projected to run into serious trouble within the next decade. Now, here's the part people get wrong when they hear that. They assume it means the checks are just going to stop. That's probably not what happens. What actually happens is the government keeps sending checks, but they do it by printing more money or borrowing more money. To cover the gap, you'll get your check. I want to be clear about that, but that check is going to buy you less. Inflation eats away at the value of every dollar they print to cover the shortfall. So you might get a bigger number on the page and less actual purchasing power in your hand. That is the trap. It's not that Social Security disappears, it's that it slowly becomes worth less than what you were counting on, and most people won't realize it until they're already living on it. This misunderstanding causes a lot of unnecessary anger too. You'll see debates online where someone says, I paid into this my whole life, I deserve it, it should be there when I'm ready. Like it's some piggy bank they get to crack open. And then someone else jumps in and explains that the money they paid in years ago was already spent on retirees back then. Both people are kind of right and kind of missing the point. Yes, you're owed a check under the current law. No, that check was never sitting in a vault with your name on it. It was always a pass-through system. Understanding that distinction changes how you should plan, because you stop treating Social Security like a guaranteed nest egg you built yourself, and you start treating it like what it actually is, a government program you're going to receive, but shouldn't fully depend on to fund the retirement you actually want. So the two pillars everyone is told to lean on, the 401 kilobits and Social Security, both have serious cracks in them. Why does almost nobody talk about this? This is where I need you to understand how financial advice actually gets paid for, because this is the part your advisor doesn't want you thinking too hard about. A lot of financial advisors get paid based on assets under management. That means the more money you keep parked with them, sitting in the market, the more they earn. Every single year, regardless of whether your portfolio actually performs well. Some advisors earn commissions for selling you specific products, annuities, certain funds, insurance products bundled into retirement plans. The incentive is not always aligned with getting you the best outcome. The incentive is often aligned with keeping your money where it is, keeping you calm, and keeping you from asking too many questions. That doesn't make every advisor a bad person. Most of them genuinely believe in what they're selling. But belief doesn't cancel out incentive. If someone gets paid more when you stay passive and keep contributing to the same accounts, you should expect them to encourage exactly that behavior, even when it's not the best move for you personally. The financial industry built an entire vocabulary designed to make you feel like this stuff is too complicated for you to understand on your own. Expense ratios, diversification, dollar cost averaging, rebalancing. None of that is actually complicated. It's made to sound complicated, so you keep paying someone else to handle it instead of learning it yourself. Let me put a real number on this so it's not abstract. Say you have $500,000 managed by an advisor charging 1% a year. That's $5,000 a year every year. Whether your account goes up or down over 25 years, that's not just $125,000 in fees, because that money also would have kept compounding if it stayed invested instead of getting pulled out as a fee every single year, depending on returns. That 1% fee can quietly cost you a couple $100,000 in lost growth over a few decades. 1% sounds small when someone says it out loud. It is not small when you actually run the math over a lifetime. That's the whole game. These numbers are designed to sound small in a conversation and be enormous over time. And the industry is banking on you never doing the math yourself. Here's the truth that nobody puts on a pamphlet. The way real wealth gets built has almost nothing to do with how much you save in an account. It has everything to do with what you own. There is a massive difference between saving money and owning assets. Saving money means you're accumulating dollars that lose value to inflation every single year. Owning assets means you have a piece of something that produces value, that grows, that can generate income on its own. The people who actually build serious wealth in this country are not the ones who save the most out of their paycheck. They're the ones who own things. They own businesses. They owned real estate. They owned equity in companies that grew over time. I built my wealth by owning businesses, not by maxing out a retirement account and hoping the market treated me well for 40 years. Now, I'm not saying everybody needs to go start the next billion-dollar company. That's not realistic, and it's not the point. The point is you need to shift how you think about your money from I am saving for later to I am acquiring things that work for me even when I'm not working. That could mean owning shares of great businesses through low-cost index funds. And I actually think that's a smart move for the average person who doesn't want to spend their life picking stocks. It could mean owning a rental property. It could mean owning equity in a small business you help run on the side. The specific vehicle matters less than the mindset. Ownership compounds. A paycheck does not. There's a concept floating around online called Coastfire, and I actually think it's one of the smarter ways to think about this whole problem. The idea is simple. You figure out a number, an amount of money invested today that, if left alone with no additional contributions, will grow through compound returns to fully fund your retirement by a normal retirement age. Once you hit that number, you don't have to keep pouring money into retirement savings. You can coast, you can take a lower paying job you actually enjoy, you can start a business that might not pay much at first, you can work fewer hours. The pressure comes off not because you stop caring about your future, but because you already built the machine that's going to take care of it. So for example, if a 35-year-old has around $150,000 invested and gets an average 8% return over 30 years with no additional money added, that alone can grow to somewhere around $1.5 million by retirement age. That's the power of ownership and time working together, instead of you grinding out contributions every single month out of fear. The earlier you understand this, the more options you have later. And options are what real wealth actually buys you. I want to be honest with you about something else too. Wealth isn't really about the number in the account. It's about what that number lets you say no to. It lets you say no to a job that's grinding you down. It lets you say no to staying somewhere just because you're scared of the alternative. And when I talk about ownership, I'm not talking about it because I think everybody needs to become a business mogul. I'm talking about it because ownership is what gives you leverage, and leverage is what gives you choices. A savings account gives you a number. A business, a piece of real estate, a stake in the market, those give you a number that can grow on its own while you're doing something else with your time. That difference, whether your money is working while you sleep or just sitting there losing ground to inflation, is the entire difference between people who retire on their own terms and people who retire because they finally hit an age where they're allowed to stop. So let's get practical, because I don't want you walking away from this just feeling anxious. I want you walking away with an actual plan. First thing, go find out exactly what you're paying in fees on every account you have right now. Your 401 kilobits, your IRA, any managed account. If you don't know the number, you cannot make a good decision, period. This isn't about distrust for the sake of distrust. It's about the simple fact that you cannot manage what you refuse to measure. A 1% fee and a 0.5% fee sound identical when someone says them out loud. Over 30 years, they are not remotely identical. Go get the actual number today. Second, figure out your real number. Not some vague idea of how I'll retire when I feel ready. An actual number. What is your life cost per year right now? And what do you expect it to cost when you're not working anymore? And then figure out how much you need in assets growing at a reasonable return to cover that every year without running out. This isn't complicated math. There are free calculators online that will do the heavy lifting. It just requires you to sit down for 30 minutes and actually do it, instead of avoiding it because it feels uncomfortable, and 30 minutes beats comfortable and clueless for the next 20 years. Third, prioritize ownership over saving wherever you can. If you're relying entirely on a 401 kilobits and Social Security as your only two legs of the stool, you are more exposed than you realize. Look at low-cost index funds outside of your retirement account where you actually have flexibility and control. No lockup until 59 and a half, no penalty if life happens and you need access. Look at whether you could build even a small side business, because owning even a small piece of something you control is worth more long-term than being 100% dependent on systems you don't control. You don't need to quit your job tomorrow. You need to start building something on the side that is actually yours. Fourth, stop assuming the government or your employer is going to fully take care of this for you. They're not evil. They're just not built to prioritize your individual outcome over the collective system. Social Security is designed to keep millions of people from total poverty, not to fund the retirement you actually want. Your employer's 401 kilobits plan is designed to check a compliance box and offer a benefit, not to optimize your personal wealth. You have to be the one who prioritizes you, because nobody else in this equation is positioned to do it for you. And that's not a conspiracy. That's just how large systems work. And fifth, get comfortable learning this stuff yourself. You don't need a finance degree. You need maybe 10 hours of real, focused learning to understand the basics well enough to ask your advisor smart questions. And instead of just nodding along and signing whatever gets put in front of you, read one solid book on personal finance. Watch a handful of videos from people who actually explain the mechanics instead of just hyping stock picks. The people who win at this game are not smarter than you. They just refuse to stay passive about their own money. And passivity is the single most expensive habit in personal finance. Here's your challenge. I want you to do one thing in the next 24 hours. Not next month, not someday. In the next 24 hours, go check the fee on your 401 kilobits or your retirement account. Just that one number. If you don't know how, search your account provider's name plus expense ratio or call them and ask directly. That's it. That's the whole assignment. It takes 10 minutes, and it might be the most valuable 10 minutes you spend on your finances all year, because you cannot fix what you refuse to look at. If this video actually opened your eyes to something you hadn't considered, don't just sit on it. Share it with somebody who needs to hear it, because most people are walking through life trusting a system that was never built to prioritize them. Subscribe if you haven't already, because I'm going to keep breaking down the stuff that traditional financial world doesn't want you thinking too hard about. Nobody is coming to save your retirement for you. The good news is you don't need saving. You just need the truth. And now you have it. What you do with it next is up to you.